it is 5:35 in our time zone, so I think let's kind of get started. And if some other ladies join, great, and they can just kind of jump in. And otherwise, just let me know any questions. Jump in anytime. Again, most of the content should be fairly applicable. We're talking about the different investment types today. Versus account types. And I'll kind of give you a brief description of that. I do want to start by introducing myself quickly and kind of giving you my background. I've been in the industry now for almost 20 years. My face doesn't show that, but I'm coming up on almost 20 years. Started as an administrator to kind of give me my exposure into this industry. And I decided it was just very important. I thought everybody needs us on a financial planning point of view, either just a little bit or a lot. And basically, every single person needs someone like us in their life. Making sure you have a good person is key. So over the years, I decided I wanted to get my license to be able to sell insurance and investment products. I've obtained a couple of different designations that allow me to take part in a lot more of the complex planning side of things when it comes to tax and estate planning. We're not talking about that at all today, and you would want to have someone different on that program for you guys to participate, because I know the tax rules are quite different between Canada and the US. So today's topic is where we want to talk about the different investment holdings. And this is part 3 of a 4-part series. So I'm not sure if you ladies had a chance to participate in the other sessions or not. So getting into the investment basics, what I want to do here is share my screen with you guys so you can see. We've got another participant. Oh, Tammy, thank you for jumping on camera. Melanie, thanks for joining us. We're just getting started. We just did a quick introduction. I don't know if you have any audio, but feel free to say a quick hello and let us know where you're from. I know a lot of people don't anticipate participating in these sometimes too, so that's fine, Melanie, if you've got a few other things going on in the background. I know we all got a busy lives. Tammy, I just want to say your tan's beautiful, and you definitely look like you're spending some time outside in Las Vegas.
Not yet.
No? Okay. So let me know if you guys can see my screen here.
Yes.
Perfect. So what I want to focus on today is the different type of investment holdings, and we can ignore the piece above in regards to the different account types, as that is applicable to Canadian account types. So what I've done is basically just listed the different types of investments in terms of their risk. So low risk to high risk, and what that entails is what type of investment return you're going to earn is going to be fully, wholeheartedly dependent on what type of investments you hold within that account. So whether it's, for you guys, the 401ks, Melanie, I don't know if you can maybe just send a quick chat or pipe up if you're in Canada or the USA. Okay, I'm going to speak to both just in case. Because the risk tolerance is the same no matter which country you're in terms of investments. So when we talk about low risk, we've got the cash and cash equivalents. So that's basically you keeping the money in your bank account where they really probably don't pay you any interest at all. I know some banks here in Canada now will offer high interest savings accounts if you keep a certain minimum amount within that account. So say it's $1,000, they might offer to pay you, right now the rates are pretty low. Like you might get maybe 0.5% in a high interest savings account if you're lucky. And GICs are also very low risk because they are what's called guaranteed investment certificates. So the investment company that you place your money with says, we're going to give you a guaranteed investment rate based on what your contract says and what type of term you sign up on. So typically the longer term that you sign up for a GIC, a guaranteed investment certificate, they're going to offer you a higher rate. Now, I say higher rate, I don't mean high rate because GICs right now are paying very, very low rates. Up in Canada here right now, you'd be lucky to get maybe 1.5% on a 5 year GIC. So, what they're saying is if you give them your money for 5 years, they're going to pay you 1.5% after 5 years. Inflation is more than that right now. So, you're almost losing money to lock it into a guaranteed investment at a rate that's low. I know I was just looking at 1 year rates today for some clients. They're averaging around 0.5% for a GIC. Depending on what you're saving for, that may or may not be something you want to consider. If you have a specific short term savings goal in mind that you don't want to take any risk at all of losing any of your money, you may want to consider a GIC just to earn a little bit of something while it's being parked for that purchase. If you're invested in your future of any sorts, whether it's, minimum 5, 10, 15 plus years out, maybe it's retirement, maybe it's a retirement home somewhere warmer. I don't know if you moved somewhere warmer, Tammy, or if you were somewhere equally as warm prior. um, so depending on, again, what that goal is going to be what type of investment you're going to hold while you're saving for that particular goal. If you are not comfortable with that risk at all and you lose sleep, if you lose absolutely any amounts of money, you want to take something that is low risk, something that is probably going to guarantee you your interest at even if it is that low rate, because that volatility might just give people some absolute anxiety. Now, I like to describe it to my clients, the thought of thinking about your investment returns on a bit of a pendulum basis. So if you're just going for low returns, and you're okay with a little bit of volatility, there may be times that you do lose just a little bit. But if you want higher returns and you want 5, 10 plus percent, there's going to be some downtimes in the market where you're going to lose 5, 10%. And it is just temporarily, but in the long term, you're going to be way more ahead had you gone through the different periods in the market, the different volatility periods, than you would be had you just gone in something safe. Um, I know it's probably been some time since we've gone into a bank, or even sat in a banker's office having any bit of a discussion. But if you recall previously sitting in your bank, your investment advisor's office, they probably had this huge chart on their wall called an index chart. And what that shows is had you invested $100 50 years ago, they show you what happened in the market over the last 50, 100 years, and they would show you what the balance of each of those investments would be. So starting at low risk, that $100 today might be $1,000. If you went to a little bit more higher risk fund, a bond type fund, maybe that money today would be 25,000. If you had gone into a medium risk fund, maybe that account might be 125,000, and so on and so on. Now, again, if you want the gains where you're hopefully, have a account balance over $100,000, there would have been some downturns in the market that you would have experienced and you would have lost some. In an ideal world, you're losing some of your gains versus your original principal or your contribution, but know that that's what comes with going into the market versus into something that's guaranteed, and that is 100% safe per se. So on that safety side, we've got the cash equivalents, which would be the money market or your guaranteed investment certificates. The next step up from there would be bonds. And we don't typically see individual bonds too often anymore. Typically, you would see bonds as part of a portfolio. But what the bonds are typically issued by the government when they're trying to raise some money. And they're pretty safe because most of the time, governments don't fail most of the time, and they guarantee that they're going to pay out on that bond. They're not offering high returns, but they're saying, hey, we need to raise some capital, and we're going to give you this amount of time at the end of this bond period. Many of you may have received bond certificates from your grandparents as you grew up. Many grandparents used to invest in bond certificates for their children and grandchildren. So that's where you would typically see individual bonds today. Um, the next level up from that would be ETF. or also known as exchange traded funds. These have really popped up in the market, I would say, in the last 5 years and have become very, very popular. And what exchange traded funds are basically computer run programs doing the buying and trading through the coded network. My background is not technology, so I cannot tell you exactly how the machine works to analyze when to buy and sell stocks, but they are completely run by a computer with no human behind them. Um, Many companies offer the exchange traded funds as an investment option that you can choose when you're picking what you want to invest in. And there may be a human that might answer questions about, hey, who do I pick as my beneficiary if something happens to me? But in terms of you saying, hey, I want a specific stock or I want this kind of holding, that's all going to be done behind the scenes with no control or input from you. And it's all done through a computer analog system. Pros and cons to it. Definitely, I would say some of the pros to the exchange traded funds is that the management fees are a little bit lower than some of the other investments that you can look at, which a lot of people do enjoy as the bonus. A lot of, I would say, do it yourself investors will often choose exchange traded funds because they don't require as much hands on management. I think if you're going to try and manage some of your own money, you got to really pay attention to the market, personally or professionally. I think if someone's managing money on a professional level, they should be doing nothing else in their day besides focusing and knowing exactly what's happening in the world and in the markets and in the economy as a whole. I don't think they should be thinking about tax planning and estate planning and dealing with tax laws. They should be eat, sleep, and breathing investment management, in my opinion, as a professional investment manager. Personally, absolutely. If you have some play money, and what I like to say, and not from my own teachings, but someone that I've heard speak in a book that I deal with, is called Paychecks and Playchecks. So this is the Canadian version, but there is an American version as well called Paychecks and Playchecks. And what the theory behind that is you want to keep your paycheck safe. You don't want to risk your paycheck. You want to ensure that no matter what you've got, your paycheck is going to be safe. Got some spare money and you want to do some playing, keep your play check into the market, especially as a do-it-yourself investor. Do not put your house at risk for a tip that your neighbor down the street tells you about. Make sure you've got some play money. Moving up from exchange traded funds, you've got stocks, which are your individual stocks. That's buying stocks of Costco, Apple, Johnson and Johnson, individual stocks. You can do that on your own as well. You can buy individual stocks. There's many trading accounts available. Now they're app based right from your phone. You can be buying and selling stocks as you please. I want to say Wealthsimple is one that's in Canada that I think is in the United States as well. So if you do want to do some of your own stock trading, that's probably going to be one of the cheaper platforms in terms of trading fees to buy and sell your own stocks. Otherwise, if you're doing it through a stockbroker, they'll probably charge you a little bit more than an online trading platform would be. But there are individual stockbrokers out there who you can just give your money to and have them literally buy and trade and sell stocks all day on your behalf. The next lineup from that would be mutual funds and segregated funds. Does anybody know offhand, are there segregated funds in the United States? Has anyone heard of segregated funds? Okay. Give me one quick second because it's definitely
That I have no idea.
I've never heard of it either.
yeah, they are. Okay. So they are offered in states. So I will talk about them and the difference between what a segregated fund and a mutual fund is. So a mutual fund is a fund of stocks. So there might be a dividend income fund, which is a fund meant to have dividend paying stocks within it that pay out dividends. So if it's a dividend income fund, that portfolio is built up of stocks that are dividend paying stocks. There might be an equity type fund that is held with equity type funds. If you had a conversation with an investment broker, you probably heard them describe your investments in terms of fixed income or equities. Fixed income are a little bit more lower risk in terms of they're meant to provide an income. And those are typically the dividend paying stocks that even when the world's fallen apart, they're full of Costco shares that are still continuing to pay, banks that still continue to pay dividends and pay out to their shareholders on a regular basis. That's a little bit more high risk. That's where they're investing in the technologies, the new startup companies. That's where you're going to earn a little bit more higher returns, but that's where you're also, when the markets crash a little bit, where you're going to have a little bit more volatility on the downside. Now, it doesn't always go that way. Some years things are really, really well, depending on when you get into the market and when you don't. You can see varying returns when you get into the equity and the fixed income market over guaranteed investment certificate type investment. Mutual funds and segregated funds, they're very similar in terms of how they are invested. All of the same holdings can be in a mutual fund or a segregated fund. You could have that same dividend income fund in either platform, but the difference between the two is a segregated fund contract comes with guarantees that a mutual fund contract does not offer. So when I say guarantees, what I mean by that is there's typically a death benefit guarantee that says on your death, we're going to guarantee that X amount of your investment is always paid out to your beneficiary, no matter what happens in the markets and no matter what the value is today. So if you invest $100,000 today and for some reason the market drops to $90,000 and you pass away, your beneficiary will still guaranteed get $100,000. So death benefit guarantee and then a guarantee on maturity. So that maturity typically is a minimum of a 10-year period out that says, hey, if you give us this $100,000 for 10 years, we can guarantee that you'll have at least $100,000 here at the end of it, no matter what happens in the world. Or it's a 75% guarantee that says we'll guarantee either 75% or 100% of your funds are here. It can be attractive because you can lock in your gains as you get them. So if that 100,000 grows to 125,000, you can reset that guaranteed value to now be 125,000. So that's a pro in that aspect. Now, some of the cons to a segregated fund is that the management fees are a little bit higher than they would be in a mutual fund. You're basically buying some insurance on your investment. So the cost to you is a little bit more. So the question really is, are these guarantees important to me? Does it come with some estate planning purposes that you get to name a beneficiary versus not being able to name a beneficiary? Then it may be worth it. If you want your funds to be paid directly to your beneficiary versus flowing into your estate when you pass away and having to pay estate taxes on those funds, you can name a beneficiary. So in terms of estate planning, there may be times that it's worth it. Or again, if you just really sleep better at night knowing that you have those guarantees, then you may want to consider that type of investment over a mutual fund. But other than that, from my experience and what I've seen, if we're investing for a 10-year period of time, our goal is to not make nothing. Over a 10-year period of time, we want to be making something. So to invest in the hopes of not making anything over 10 years, even if you're in a low risk fund, in my opinion, I don't think it's worth paying those guarantees because that eats out of your profits. If your fund earns you 5% and you're paying 2.5% in fees, well, now you're only earning 2.5%. But if you're only paying 1.5% in fees, then you've earned 3.5%. Those fees add up over time, especially if this is a retirement account for you. You think about how much those fees you pay over 25, 30-year period in time, they do add up. So every little dollar counts. And at the end of the day, with proper advice and making the proper selections, this is your retirement and you're spending money. So you want to be working with someone who's ensuring that you're keeping more of your money in your pocket and less in the salesperson's pocket, less in the government's pocket, because I consider the government to be the biggest mob in town. They tax everything, especially here in Canada. We pay taxes on so many things and such high rates and silly tax brackets. I know here in BC, we have, I think, 13 different tax brackets. One of those brackets is a $1,600 income difference. So if you make, 45,000, you're taxed at one rate. But if you make 46,400, you're taxed at a different rate. 1,600 differential. I don't know why they would create an extra tax bracket for that. So in terms of, is it worth paying the fees? Is it worth the guarantees? That's a question that absolutely you want to reach out to a financial planner to help answer. I do suggest reaching out to a financial planner and not just a salesperson at an investment company. And I think I'll touch on that here at the end, and I'll just finish my way through the investments, and then we'll talk about the difference between an investment salesperson and an actual financial planner and what kind of questions you should be asking them. I think I saw that I had a question coming here, so maybe just give me one moment. An annuity. Okay, so an annuity is something slightly different. An annuity is a type of an account that guarantees how much payments you're going to get over that, either your lifetime or a guaranteed period of time. So when you have a lump sum, like $100,000, you could invest that into an annuity, and that annuity says, over your lifetime, we're going to pay you X amount per month or X amount per year. So it guarantees your payments. Now, annuities have zero flexibility. So if you decide in 3 years you don't want to be an annuity, you cannot move your money out of an annuity. You're locked into an annuity once you purchase an annuity. Again, they do offer some guarantees where you know that no matter what happens in the market, you're still guaranteed to get X. Pros and cons on that is, if you plan on getting that money over your lifetime and you pass away early in your lifetime, then it may not be worth it, because now they've only paid out X amount when you were expecting to be paid out Y. They do offer, again, some guarantee periods, but if after 10 years you pass away 10 years and 3 months later, you're still not getting your money out of it. So pros and cons with every decision. Pro on annuities is you have guaranteed income. You don't have to worry. Cons is there's zero flexibility in it. Once your annuity is set up, your payments don't change. They may or may not increase with inflation, depending on whether you choose and to purchase that option with your annuity or not. Each guarantee and each feature that you purchase within your annuity will dictate what that monthly payment is going to look like. But thanks for that, Miley. Moving past stocks and mutual funds and segregated funds, they have the real estate investment trusts. So what those are typically, they look like the land development deals or funds that hold real estate investments. So rather than funds of companies, they host real estate investments. So it might be a new subdivision that's being built somewhere, or a new business center that's being built. Sometimes people do it on personal mortgages. So it's an investment subsidiary that creates a fund that is solely holds only real estate. So it's a real estate investment trust. Zero guarantees with those. You're at the mercy of what the economy is doing, what the housing market is doing, providing that these places are all being rented out on a regular basis. They can have some amazing returns, but also if the economy goes sideways and housing prices drop, or people are walking away from their houses like they did in Phoenix a number of years ago in Arizona, higher risk, higher return with the real estate investment trusts. And then again, real estate as standalone, a lot of people do decide to put their money in real estate versus specific individual investment funds. Pros and cons to each decision. With real estate, your money is not liquid. It is tied up in those holdings. So if you do need access to those funds, they may be difficult to get. I know typically you can have lines of credit set up against these properties if you do have some equity. But you have to be able to qualify for that line of credit. You have to have, access to it if you're going to need to pull it out. Being able to access that is key. There's a number of deciding factors, just like qualifying for a loan. Same thing as line of credit. They look at your total debt servicing ratio. So the liquidity in investing in real estate is pretty tricky. That's one of the cons of it. Uh, Potential for high returns, but again, that dictates on what part of the country you're in. I definitely know that, same in Canada, house prices in San Francisco are going to be a lot higher than they are in a smaller part of the country that doesn't have a whole bunch of high rises and scenic tourist stuff, right? Same here in Vancouver and Victoria, on Vancouver Island, Toronto. The house prices here are triple, sometimes quadruple what you would pay for the same type of property in another province here. So the economy and the inflation and interest, those are all some risks that you face if you want to invest in real estate. Another consideration is the taxation of real estate. So when you sell these properties, the government taxes them. I can tell you that in Canada, any property that's not your principal residence, on the sale of that property, you have to pay the government 50% of your gain. You have to declare that as income. So if you bought a property for 150,000 and you sold it for 300,000, you declare 150,000 gain. 50% of that is taxable. So that'd be a $75,000 income in your tax return that year. That's now going to bump you up to a number of tax brackets. So that's something to take into consideration. Um, you might want to just pass those properties on to your kids. Maybe it's a family cottage that you invest in versus a rental condo building or something along those lines. But there, again, is pros and cons to the real estate side of things. And then when we talk about commodities on the high risk side of things, commodities would be things like your materials, your golds and your silvers, uraniums, all these other new metals that are coming out that are, again, potentially high risk. Um, Up here in Canada, the cannabis industry is one of those commodities, kind of high risk things. There's so much grayness in terms of regulations, health and safety, how to treat these companies. So I just was reading yesterday, one of the main companies that got set up as a publicly traded company is now being sued for fraud because they had set up their facilities pre-approval, lied about it, and now that company is probably going to go belly up, and all of those shareholders are now going to lose the money in what was, that hot tip from the neighbor. This company is doing great. So um, paychecks and playchecks. You got some play money that you don't care what happens, absolutely go for it. Cryptocurrency, I think that's another pretty hot topic that should be brought up as well. A lot of hot gains in that market. It's hard to argue it, but talk to people about how are they getting their money out of that. Are they sleeping at night watching the markets go up and down and what's happening with that? Depending on when you got in, you're a lot better ahead than some of your buddies might be who got in before you. Um, so that's kind of, I would say, on that grand scale, the different type of investment holdings that you can hold within the different types of accounts. Does that make sense? I don't see any other questions popping up here, so I feel like I'm making sense. If you guys do have any questions, feel free to pop them into the chat, take yourself off mute. Okay. All right. So I want to move on then. If we're done talking about investments, I want to talk about what you want to look for when you're, who to talk to and what to ask when you're meeting with an investment advisor, an investment salesperson, a financial advisor, financial planner. So I think at minimum, you want to ensure that your person has a designation of some sorts here in Canada, and I know they're applicable in the United States as well. A certified financial planner, a CFP designation, is kind of the industry standard. It's not mandatory at this point, but it's kind of the industry standard that if you want to do more than just have a license to sell products and you want to actually be educated and knowledgeable and technical and be able to offer tax, retirement, debt management, budgeting, if you want to be able to offer advice and offer written plans and do more than just sell products, a certified financial planner is going to be that minimum designation that you want to ask someone if they have. But ask them. Do you have a designation? If they have no designations, that means they're strictly just licensed to sell you products and earn commissions off of those sales. Those commissions that they earn are supposed to be for the advice that they give. That's what you're paying them for. That's what those management fees are for. Should I invest in this type of account, or should I have this type of account? Do I want that taxable type of account or the non-taxable type of account? How much in the taxable account versus the non-taxable account? Those are all questions that you need to ask your financial planner, and what they should walk through with you. With the taxable account, where you get the tax deductions for your contributions, you might have X amount of space available, but that doesn't necessarily mean that you should be using it all if it's not going to benefit you on this year's tax return. That's what a financial planner is going to help you walk through, versus someone who's just going to sell you product. So ask about their designations. You want to ask them what kind of management fees you're paying, because every type of investment account has a management fee attached to it. That's how everybody gets paid. Nobody works for free, from the people processing the paperwork, the people that are selling you the account, the people that are buying and selling and doing all the individual stock trading, the people that are administering all the regulators who have to they have to disclose every single trade that happens in every portfolio. So there's a lot of behind the scenes work, and that management fee is what pays for all of that behind the scenes work. So again, nobody works for free. You got to pay some fees. If you want to earn 8%, you have to be comfortable paying 1 or 2% to get 8%, right? It's fair. But what are those fees, and how much are you paying? And are you paying 2% or are you paying 4%? Because you can have very similar holdings with very different management fees. And then for those fees, what services do you get? What value add is that financial planner actually giving to you? Can you call them? Do they offer you advice? Or do they just strictly call you when they need to make a trade, or you call them when you need to invest some more money? Do they offer educational events? Do they offer client appreciations? Do you hear from them on any type of basis at all? Ask them how they get paid. Do they just strictly get commissions from all of the sales? Or are they a fee for service planner? And if they're a fee for service planner, then they're typically offering unbiased advice. So that's definitely important as well. Depending on your needs, if you want to get an overall plan, that's what you're looking for, is how are they getting paid for that. Some people just have that short-term investment goal, and hey, I've got this extra money from my winnings in Las Vegas, and I want to invest my winnings. So where do I put them? Some people just have those specific goals and needs at that time. So that's okay as well. But in the big picture, you want to be able to tie all those pieces together. There's a saying of businesses don't plan to fail, they fail to plan. And I think that applies to people and life as well. Nobody plans to fail, but we just fail to plan in terms of our retirement, our risk management, debt management. How many people have had credit cards where they may not have paid off their full balance in time, or life happens, right? And tax planning. Tax planning is one of those questions that you're going to ask your advisor. So top 3 takeaways of what to ask your advisor is: what are their designations? What are their fees? And what services do you get for what you're paying for them? Now, I've kind of thrown out a lot of information here, and I don't see any questions. So I don't know if everyone's just kind of digesting. We want to wrap it up today. If you guys want to have any Q&A at all.
I have a question. I was wondering, for those investment holdings,
Yeah.
in terms of like different like financial goals that someone might have, if it's a shorter time horizon, like 5 years or something, should it be in one of the low risk options, or should it kind of be like in the middle ground? Like, how do you decide based on the number of years of your time goal? Like, how do you decide where to put your holding?
I would say, if it's 5 years, you're pretty good to go low to medium risk, because over a 5 year period of time, a lot could happen, but typically stuff's going to rebound within 6 months, a year, 2 years max. Like even some of our worst drops that we've seen, they've recovered within kind of 2 years. If we look back at like 2008, 2009, everything recovered within 2 years. March of last year, everything fell completely to rock bottom. Had a client
Mhm.
I think their funds went from, about 860 to 730, and then today when I did their summary, they were sitting around 980.
Mm.
So
So then I guess, okay, so let's say like I put money into like a medium risk option. At what point do I start transitioning the holdings into a lower risk option as the timeline approaches?
income type fund, so something that's really meant to pay dividends versus, so if you're aiming kind of maybe 4 or 5% versus something
Mhm.
that's an equity based holdings for something higher, you're going to earn more than you would if it just sat in that high interest savings account, but you're not going to have the same volatility.
I see.
Yeah, and if it's fixed income, typically what's going to happen is you'll be receiving dividends, and if the market does crash a little bit, you're just going to be losing some of your gains, not your actual
Okay.
principal. So if you invested $5,000, it's going to grow to 6,500. It might drop to 62, go back up to 66, drop to 63. Again, it's just some of those gains that are eventually being played with, unless the market drops tomorrow after you invest your funds. But again, within
Mhm.
5 years, it's going to recover. So if you're okay with a little bit of volatility, I would consider looking at something that's more fixed income based and stay
Okay.
away from equities if it is really just a 5-year goal.
Thank you.
You're welcome.
Can I ask another question?
That's what we're here for.
What are your opinions on like robo advisors? Um, like in the US we have Betterment. I don't know if you guys have it up there, but like those types of offerings.
So if you want to be playing with your own money and you having that control, they're good because they're low fee. Like robo advisors are low fee, but typically you're not really getting the advice. So you're telling them, hey, I want to put money in my 401k, or I want to put money in my Roth. And excuse me if these are not fully the correct names. Being based in Canada, we don't have these same accounts. So you're telling them where you want to put the money versus someone saying, well, you've already kind of maxed out your tax contributions for this year, so maybe put just this year and put the rest in this account. Like that advice is not there for the robo advisors. But if you are any of you ladies part of the FIRE movement? Does anybody know FIRE? Financial Independence, Retire Early. FIRE, Financial Independence, Retire Early. So it's a movement, I don't know, a lifestyle, a way of living where people are making conscious decisions to not have to work 9 to 5 for the rest of their life. And how can we retire early? Maybe it's working part-time while still doing some things, maybe building some passive income streams. But with FIRE, they do a lot of research, a lot of reading. People are really involved in their kind of overall, they're very conscious of all of their decisions, where their money goes, where it's being saved. They really do enjoy the exchange traded funds or the robo advisors because there's lower fees there. But if you look at these funds versus someone who's professionally managing your funds, they're going to be outperformed. So you might pay, 0.15% more to have someone else do it, but you're getting the advice. Like you get what you pay for. But if you're confident and you've done your own research, those robo advisors can be great because you are going to pay a little bit less for them.
Okay, thanks.
Oh, you're welcome. All right, ladies. Well, thank you so much for coming on and supporting Girls in the Wild, which is an organization out here that helps young women get into the outdoors. Thanks for being part of Women Who Explore, and we hope to all meet in person one day.